Hello and welcome to Sovereign Financials, financial education for everyone.
Hi guys, welcome back to Sovereign Financials. My name's Mike. I am the founder of Sovereign Financials, and today we're going to start our podcast slash videocast of what we're going to call our Easy Money series, where we attempt to just kind of talk you through and what's going on in the markets and try to make some of these more complex topics easy for everyone to understand. So today we're going to focus on the Powell speech, who's head of the Fed, that he just had yesterday, in regards to what he considers their new target of being average inflation instead of just their inflation targets. So for a very long time, the Fed has been aiming for having like 2% inflation per year. And that is how what they deem to be like a good economy will like cause increase in jobs and decrease unemployment and increase in GDP growth, just basically an overall healthy economy. The problem with that, number one, is 2% inflation compounding over 36 years already decreases the amount of purchasing power you have by half in that 36 years. So it's already kind of unfortunate for people, especially the bottom 50% of Americans, where if people are holding a lot of cash in the first place, the cost of everything is going to double for them in a period of 36 years. So by using this average inflation target, what they plan on doing is having inflation go over 2% for the next several years in order to make up for the under 2% inflation they've had over the previous couple years. Now, what this means is they're going to keep having easy monetary policy. So they'll keep interest rates low, and they're going to keep essentially printing money until they can get inflation to go over 2% for an extended period of time until they have unemployment where they want it to be. Now, this is kind of a complicated thing. So as we saw with quantitative easing, where the Fed goes out there and just buys a bunch of U.S. treasuries or bonds, that doesn't actually cause inflation because the banks can't use that as directly as money. It's like something called Federal Reserves, which is a little bit different. But basically what we've seen since the coronavirus happened is the U.S. Treasury and the Fed have kind of combined a little bit. So the U.S. Treasury is essentially in terms of the fiscal spending. So the U.S. Treasury is creating some special purpose vehicles, just think of it as like small little companies. The Fed is going to fund those companies, those special purpose vehicles, and then the U.S. Treasury is able to send money directly to people. Now that will cause inflation. That is very different because that is literally putting money into the economy that wasn't there before. And we're going to start seeing more, I think, of this U.S. Treasury plus Fed, so fiscal being the U.S. Treasury and monetary being the Fed, policies combined in order to spark the inflation they want. Now, there's something here that I want to talk to you guys about interest rates. So there's a very common, most people don't understand the difference essentially between nominal rates and real rates. So nominal interest rates is the interest rate that is printed right there, letting you know how much that bond pays you. So U.S. Treasuries right now, the nominal 10-year interest rate. So if you buy a U.S. Treasury, a government bond, and it's the 10-year bond, it'll pay you 0.6%. Okay, that's a nominal yield. So people will think like, oh, if I buy this U.S. Treasury, I'm getting 0.6%, per year, and that's not real. That's not the real number. So real interest rates means like, hey, what am I actually getting paid? So real interest rates take into account two things. One is what's the nominal rate? What are they saying they're paying you? Minus the inflation rate. So that means then if inflation's really high, right? So if inflation's 5% a year and a bond's only paying you 0.6% a year, well then you're losing money, right? So let's break this down for the 10-year U.S. Treasury. So 10-year U.S. Treasury, the real rate is equal to 0.6%, which is what they're saying they're paying you, minus inflation, which let's say the Fed's going to aim for 2.5% inflation, right? That's going to give us a negative number, right? So 0.6. Let me pull up my paint here for you guys. So the nominal yield is 0.6%, which you can see, I'll just move this over. So the nominal yield, the interest rate they're paying is 0.6%, but real is nominal minus inflation. So if the 10-year U.S. Treasury, the real bond rate is, so they're giving you 0.6%, but inflation's 2.5%, well then you're actually losing money. And how much are you losing? You're losing 0.6 minus 2.5, you're losing minus 1.9%. So right now, if you are an investor and you're buying U.S. Treasuries, or you have like, your typical 60-40 portfolio where 40% of your portfolio is bonds, if you're, obviously not all your bonds are going to be in U.S. Treasuries, but if you think you're getting paid 0.6%, which is already terrible in the first place, you're actually losing, or you're going to end up losing 1.9% per year. Now, the Fed is saying they're doing this in order to increase to basically grow the economy, like increase GDP growth and decrease unemployment and everything. But in my opinion, this is probably really to help inflate the U.S. government, a way to inflate their way out of all the debt they've accumulated. So if you're people that are holding U.S. Treasuries or government bonds right now, if you have inflation running hotter than the interest rate they're paying you, then the debt starts going down. And how much is debt going to go down by? It's going to go down by maybe 1.9% per year. The real debt is going to be going down as that debt gets inflated away. Basically, if you go like Venezuela, where your money becomes worthless, like you have tons of money is floating around, then it's really easy to pay the debt that used to be really big, because now the debt isn't so big in real terms. So I know it's kind of complicated, but basically the big point I'm trying to say is if you keep interest rates really low and you increase the inflation rate, then what that does is that decreases the debt burden on a country and also individuals. So that's not very helpful, right, for most investors. The key point there is that holding U.S. Treasuries is probably a losing proposition over the long term. Now, if U.S. Treasuries go negative, there is some price appreciation. You can actually do kind of well for a little period of time, but that's a whole other topic. But for most people, right, what does that mean for most of us? Okay, that's great. So interest rates are going to be low. We're going to have inflation high. That sucks. Two things. One is you probably need to be invested in assets. So you need to have, like things that are going to benefit from inflation. I think gold and Bitcoin are great options for that. However, real estate usually does well with inflation, and then, stocks, specifically like the NASDAQ 100, according to Paul Tudor Jones, but stocks typically go up in inflation as well. Now, will they keep up with inflation? That's a little harder to say, but they will go up. The key point is if you have most of your wealth staying in cash, that cash is going to be degraded. Your purchasing power is going to go down over time. So, right now it might take you, $7 to buy a piece of steak, but, another year from now it might be, $9. And if you had all your money in cash and you didn't have any assets that were growing, you just lost a bunch of money. And actually we've seen that over the past year, the price of beef has gone up by 34%, according to the Bureau of Labor Statistics, official government numbers. Price of bread's gone up by 14%. So you got to make sure you have some investments that are actually going up at the same time. And then if they're going to aim for higher inflation, right, that's even going to be worse for us. But let's talk about some other stuff here. So if you have a mortgage, right, number one is if your interest rate's in the 3 to, God forbid, 5% area, you probably need to refinance that. Refinance that down. So there are lenders out there right now that will give you 2.4% interest on mortgages now, and this is for refinances. So let's look at this numbers here, right? So let's find out, okay, well, if our interest rate on a mortgage is 2.4%, what's our real interest rate, right? Because we have to account for inflation. So if you say that 2.4% is our mortgage, and the government plans on inflating at 2.5% a year, well, look, all of a sudden, our interest rate now is negative 0.1%. So what that means is that the Fed is actually going to help inflate away some of your debt. Now, we're not recommending that you go out and take a bunch of loans, because increasing the total amount of debt you have increases your leverage, which means if you lose your job or some other crisis comes up and you need to pay out a bunch of money, it increases your chance for bankruptcy. But some of these things to take advantage of is if you have a mortgage that you have 3 to 5%, if you can get that below whatever the Fed's inflation target is, whatever inflation they hit, you get a negative interest rate, and some of that debt starts kind of getting easier to pay as inflation kicks up. The other thing, I think this is the biggest part, is student debt, right? Because student debt is a big one. So student debt, a lot of that stuff right out there right now, the government has given you is between 7 and 8%. It's really, really high. And God forbid the Fed ever aim for that high of inflation. But you can, there's many companies out there that will take that student debt down to 1.5 to, let's say, 2% interest. So if you refinance that down, let's say you get that down to 1.5%, let's figure out what your real interest rate is, right? So 1.5%, let's say, is the interest rate you have on your student debt. You definitely need to refinance it if you're in the 7 and 8%. That's kind of crazy. Just refinancing that down from 8% to 1.5 is going to save you tons of money in the long term as it is. Now, if the Fed aims for 2.5% inflation and you're at 1.5% on your interest rate, now you're at negative 1.0%. So once again, if you can get that interest rate down low, that means the Fed is going to help you inflate that debt away, right? So here's a couple ways to take advantage of the increased inflation. Number one, inflation protection assets, you need to have like gold, probably have some gold, have some Bitcoin, have some silver probably, and then other assets, right, like stocks, maybe some real estate, and then have your emergency fund, obviously 3 to 6 months, but don't hold all of your wealth in cash. That's going to get destroyed over the next couple years. And then your debts, try to refinance your debts down to the lowest interest rate you could possibly get, especially if you can get less than like 2.5%. I think that's going to be a really golden number if you can get below there. So those are the kind of topics we want to talk about today. There's a couple other things. So in terms of like, how do you protect yourself from all this inflation, right? And the typical answer for the past thousands of years has been like gold. Like, hey, the government's being irresponsible with the money, just hold your money in gold and you're fine. And that's probably a good alternative. I think the new version of gold is going to be Bitcoin. And if you look, there's a company called Microstrategy, and they're a $1.4 billion company in the NASDAQ. They invested $250 million into Bitcoin. And when I say they invested, I don't really mean they invested, but they put it on their balance sheet as one of their treasury reserve assets. And what that means is that they're basically looking at it like this. They say, look, the US dollar is going to be inflated over the next couple of years, and the US Treasury, it's paying a little bit of a positive interest rate, but after inflation, we're getting a negative interest rate. So we're going to take a guaranteed loss on our US Treasuries. Well, instead of doing that, we're going to hold Bitcoin as a cash equivalent, essentially. And they understand they're going to have increased volatility. Like the price will go up, the price will go down, up and down, but they're hoping over the long term that the price will go up, or at least remain steady, right? If they don't lose any money, if it's in terms of purchasing power, it's already a win for them. So they're going to deal with the volatility by having some cash on hand, which would essentially be like your emergency fund for us. For a company, it's more like their operating costs, like having their operating costs in actual cash. And that's the way they're going to use to protect themselves from some of this inflation. And there's some other companies that are doing this too. There's a food company up in Canada who said that they move a lot of their money over to Bitcoin, some of their reserve assets. So not an investment like, hey, I might make money, I might lose money, hopefully it'll do well. Like they're like, hey, you know what, instead of holding cash or instead of holding US Treasuries, we're going to hold some Bitcoin because at least there it's not a guaranteed loss. And I think this is a trend that we're going to start seeing. We're going to start seeing a lot more companies that come out and say like, hey, you know what, instead of taking a guaranteed loss on US Treasuries, on government bonds, we're going to just put our money in like Bitcoin. That's the easiest one to transact in. Maybe some companies will end up holding some gold for more long-term, storage of their wealth. Another very popular investor named Paul Tudor Jones. He's an investor, trader, and a hedge fund manager. He took 2% of his assets and ended up purchasing Bitcoin. This is probably a couple months ago. And he says he believes it's going to be, the fastest horse, meaning that he thinks that we're going to see a bunch of inflation. And he thinks that the asset that will benefit most from the inflation will be Bitcoin, right? And if billionaires are putting some of their money in Bitcoin, like that's something that you need to at least look into and be like, hey, is this something that I need to do, or do I not need to do it? But you got to figure out if the rich are doing it. You got to figure out if it's something that you need to do or not. And we're not giving specifically financial advice on that, but you just got to figure out. You got to really investigate it and determine if you think it's a good thing or a bad thing. And same with gold. And then another thing is with gold is Warren Buffett, who has multiple interviews in the past is saying he's 100% against gold. He'd rather own, like all these other companies rather than look at a pile of gold, and also all these interviews against gold. He had a very interesting interview for his Berkshire Hathaway meeting in 2020, and there's probably 2 or 3 minutes where he was it almost looked like he was perplexed at basically saying that we're under having this great experiment in terms of monetary policy right now. And he's not sure how it's going to end. He basically, it seemed like he didn't think it was going to end well, but he didn't, come out and say that. During his most recent 13F filing, he ended up cutting down on his banks a little bit, but more importantly, his bank investments in a little bit, right? Because these negative interest rates, like these really small interest rates, like they kill banks. So he kind of cut down on those a little bit, and then he ended up buying a gold mining company, right? So the first time he's done that, the guy's 80 something years old. I think that's pretty interesting, and I think that's pretty telling of what he thinks is coming in the future as well. So guys, that is it for our episode today. Hopefully you found it educational and helpful. This is our first, Easy Money podcast, and I know we would love to hear you guys' feedback. Hope you guys do well out there. Stay safe and prosper. See ya. Hi guys, thanks for making it to the end of the video. If you like the content you saw here today, feel free to check out our website at sovereignfinancials.com. There we publish a newsletter on a monthly basis that kind of dives in deeper to all this content. I'm going to try to leave a link to the newsletter on the YouTube video, and I'll also leave a link down in the comments. Thanks again, and we'll see you guys next time.